Welcome to Innovative Market Group's Video Series 1, Lesson 2, The Concept of Compounding. My name is JR, and I'll be your instructor and narrator today. Albert Einstein was of the opinion that compound interest is the greatest mathematical discovery of all time. While some may beg to differ, we think this is true because, unlike the calculus or trigonometry you studied back in high school, compounding can be and is used in everyday life. Compounding, sometimes referred to as compound interest, turns your working money, your invested funds, into a state-of-the-art, very powerful income-generating tool. An easy way to describe compounding is that it is the process of generating earnings on an asset's reinvested earnings. To make compounding work, two things are needed: the reinvestment of earnings and time. The more time you give your investments, the more you are able to accelerate the income potential of your original investment, and this allows your money to work for you instead of you working for your money. If you are making any kind of investments and your return is added to your investment, you are benefiting from compound interest. Compound interest is a way to increase your money at a faster rate. We have included for your reference the formula for compounding interest. The easiest way to learn compound interest is through the use of everyday investing examples. And to that end, we have offered you 3 examples of its everyday usage. While it's not important to know the formula, it is very important that you understand how it works and what it will do for you and your money. The examples may seem a little redundant. Each is worded a little differently to make sure the concept is understood. The formula for calculating compound interest is as follows, where P, principal amount, initial investment, R, annual interest rate as a decimal, N, number of times the interest is compounded per year, T, number of years, and A, amount after time, T. We will now take a look at compound interest example number 1. If you were to deposit in a bank the amount of $1,500 and the bank is paying an annual interest rate of 4.3% compounded quarterly, to find the balance after 6 years, we would use the compound interest formula. P equals 1,500, R equals 4.3100, or 0.043, N equals 4, and T equals 6. So, the balance after 6 years is approximately $1,938.84. Compound interest can not only be compounded yearly, but it can be compounded on a quarterly, monthly, or even a daily basis. The shorter the time period for the compounding basis, the better the terms are for you as a depositor. Compound interest helps your money grow faster. The idea of compounding doesn't just apply to bank deposits. It can apply to stocks, bonds, mutual fund investments, dividend reinvestment programs, and even real estate investments. It can apply to any kind of investment where the time basis interest return on the original investment is added to the original investment, and the next time basis interest is applied to the new balance. Let's now examine compounding interest example 2. In an effort to help you understand this amazing money-generating concept, let us go through one more example with different parameters. If you invest $10,000 today at 6% yearly, you'll have $10,600 in 1 year. Let's take a look at that simple math involved here. $10,000 times 1.06 equals $10,600. You now have $600 interest profit for the year. Now let's say that rather than withdraw the $600 profit gained from interest, you keep it there for another year. If you continue to earn the same rate at 6%, your investment will grow to $11,236 by the end of the second year. Once again, let's take a look at that simple math involved here. $10,600 times 1.06 equals $11,236. You now have made a 2-year compound interest profit of $1,236 on your original investment of $10,000. I'm quite sure You'd agree that the money has worked for you instead of you working for your money in this example. Because in example number 2, you reinvested the $600, it works together with the original investment, earning you $636, which is $36 more than the previous year. This little bit extra may seem like peanuts now, but let's not forget, you didn't have to lift a finger to earn that $36. More importantly, this $36 also has the capacity to earn interest. After the next year, your investment will be worth $11,910.16. This time, you earned $674.16, which is $74.16 more interest than the first year. This increase in the amount made each year is compounding in action. Interest earning interest on interest, and so on and so forth. This will continue as long as you keep reinvesting and earning interest. We will now run through compound interest example number 3. Starting to invest early is of the utmost importance, and to demonstrate, we will consider 2 individuals. We'll name them Jane and Jim. Both Jane and Jim are the same age. When Jane was 25, she invested $15,000 at an interest rate of 5.5%. For simplicity, let's assume the interest rate was compounded annually. By the time Jane reaches 50, she will have $57,200.89 in her bank account. Jane's friend Jim didn't start investing until he reached the age of 35. At that time, he invested $15,000 at the same interest rate of 5.5% compounded annually. By the time Jim reaches age 50, he will have $33,487.15 in his bank account. Now, let's take a look at what happened. Both Jane and Jim are 50 years old. But Jane has $23,713.74 more in her savings account than Jim, even though he invested the same amount of money. By giving her investment more time to grow, Jane earned a total of $42,200.89 in interest, and Jim earned only $18,487.15. As it should be in everything you do in the future, you should verify the calculations above for yourself. You might have to go over them several times before the concept becomes clear. However, once you understand the concept and then use it in your investing, you will then understand how money can work for you instead of you working for your money. Both Jane and Jim's earnings rates are shown in the following chart. As you can see, both investments start to grow slowly, then accelerate as reflected in the increase in the curve's steepness. Jane's line becomes steeper as she nears her 50s, not simply because she has accumulated more interest, but because this accumulated interest in itself is accruing more interest. Jane's line gets even steeper, her rate of return increases. In another 10 years, at age 60, Jane would have nearly $100,000 in her bank account, while Jim would only have around $60,000 at age 60. That's a $40,000 difference. When you invest, always keep in mind that compounding amplifies the growth of your working money. Just like investing maximizes your earning potential, compounding maximizes the earning potential of your investments. But remember, because time and reinvesting make compounding work, you must keep your hands off the principal and earned interest. Now that you know how compound interest works, consider one of the more interesting peculiarities of compound interest, the rule of 72. It works like this. When anything is compounded on a yearly basis, when the added together interest rates equal 72, then the amount is doubled. For example, if you earn 6% per year, then in 12 years, 6 times 12 is 72, the amount will double. That means our mythical deposit of $10,000 at 6% interest will become $20,000 in 12 years. Compound interest can work for you if you allow it to. Compound interest helps your money grow faster than you'd think possible. It is important to make sure that any money you invest is compounded at the lowest time frame possible to increase your returns. To put it another way, it is much better to have your interest compounded daily than it would be to have it compounded monthly, quarterly, or yearly. In investing, as with almost anything in life, you should have a plan before you embark on whatever you are pursuing. And investing is no exception. In fact, when it comes to investing, it is of the utmost importance to have and adhere to an investing plan at all costs. We will delve into developing your investment plan and other important issues about you and your success in investing in our next IMG Investing Presentation Series 1, Class Number 3, Know Thyself. We sincerely hope this innovative market group's presentation, The Concept of Compounding, has been informative and has brought you one step closer in your quest for knowledge and success into the world of investing. Once again, this is JR, and I thank you for spending your time with me today. And I look forward to being your instructor and narrator in your next IMG class. Please continue now to Innovative Market Group's Investing 101 Series 1, Lesson 3, Know Thyself, or any of the other investing educational classes offered by Innovative Market Group. Until next time, thank you.